Hey traders, welcome to today's deep dive into one of the most powerful concepts in the market, liquidity. Liquidity is the true engine behind price movement, and if you can master how it works, it can completely transform your trading game. Imagine being able to read the market like smart money does, aligning yourself with the big players like banks and institutions instead of falling victim to their traps. Most traders get caught on the wrong side, losing money in liquidity traps, while smart money collects their profits. But in this video, I'm going to take you beyond the basics. We're breaking down liquidity concepts step by step, from the fundamentals to advanced strategies, so you can finally learn how to trade alongside the market makers instead of against them. By the end of this video, you'll not only understand how liquidity works, but you'll know how to leverage it to spot traps, avoid common mistakes, and maximize your profits like a pro. So make sure to give this video a thumbs up if you find it valuable, and subscribe if you're ready to take your trading to the next level. So, what is liquidity? In the context of smart money concepts, liquidity refers to specific areas where large institutional players are likely to execute massive orders. These zones are filled with opposite market orders, such as stop losses, and stop orders set to capture breakouts. Think about it. Around key levels like major highs, lows, trend lines, or areas with equal highs and lows, liquidity is waiting. The trick is that smart money often pushes the price toward these zones to grab that liquidity before the real market direction takes shape. This is why traders frequently fall into bull or bear traps. Before we dive deeper into liquidity strategies, let's focus on two crucial concepts that can significantly improve your trading performance: buy-side liquidity and sell-side liquidity. Mastering these liquidity zones won't just help you avoid getting caught in traps set by market makers. More importantly, it will allow you to follow their footprints and turn their tactics to your advantage. Let's start with buy-side liquidity. This is an essential concept that's key to understanding how market makers operate. So what exactly is buy-side liquidity? Simply put, it's the volume of pending buy orders, also known as buy stops. These orders are often placed above key highs, whether that's the week's high, the day's high, or equal highs. Here's how it works. When traders execute sell orders, they protect those positions with buy stops in case the price moves against them. These buy stops rest above those significant highs, and smart money knows it. Market makers target these highs, sweeping them to trigger those buy stops. Once they do, they convert those pending orders into market orders and then drive the price in the opposite direction. This process is known as a liquidity hunt, a tactic designed to trap retail traders. Look at this chart example. As you can see, the market formed equal highs, known as buy-side liquidity. Market makers swept the old highs, cleared the buy-side liquidity, and moved the market down, perfectly illustrating a buy-side liquidity hunt. Now, let's move to sell-side liquidity, which works in a similar but opposite way. Sell-side liquidity refers to the accumulation of pending sell orders, particularly sell stop orders, placed below key levels like weekly lows, daily lows, or significant historical lows. When traders place buy orders, they often protect their position with sell stops to mitigate potential losses if the price moves downward. These sell stops rest below those major lows. And just like with buy-side liquidity, market makers will target those lows, triggering the sell stop orders and converting them into market orders. Once they've captured that liquidity, they manipulate the market in the opposite direction, again profiting from retail traders. In essence, sell-side liquidity highlights how market makers exploit the relationship between pending sell orders and market direction. Look at this chart example. You can see the price broke through established lows, sweeping sell-side liquidity. Once the sell stops were cleared, the price reversed direction and moved up, demonstrating how market makers capitalize on sell-side liquidity. Now that you understand buy-side and sell-side liquidity, let's take a closer look at how market makers target these liquidity zones. They typically use two main tactics: the liquidity sweep and the liquidity run. Knowing how these tactics work will give you the insight you need to follow in their footsteps and capitalize on the same strategies smart money uses to dominate the markets. Let's start with the liquidity sweep. A liquidity sweep happens when the price makes a sudden move to grab liquidity before reversing in the opposite direction. For example, the price might push up towards equal highs targeting buy-side liquidity, and momentarily break above those highs. But instead of continuing higher, it quickly reverses, trapping traders who entered long positions. Even if the price closes above the highs, it may reverse just as quickly with a wave of strong selling momentum. This is called a liquidity sweep because the primary purpose of this price movement is to capture liquidity, trapping retail traders in the process. Once the liquidity is taken, the price reverses, and smart money profits from the chaos. Now let's look at the liquidity run. A liquidity run is when the price moves in the direction of the prevailing trend, targets liquidity, and keeps going without reversing. For example, in a bullish market, the price might target a previous high, sweep the buy-side liquidity sitting above it, and continue rising to make a new high. By understanding these two tactics, liquidity sweeps and liquidity runs, you'll not only avoid getting trapped by false breakouts or breakdowns, but also be able to position yourself alongside smart money and ride the trend for maximum gains. But as traders, our goal is to follow the footprints of market makers, and the liquidity sweep is one of the clearest footprints they leave behind. Now, let's look at a real chart example of a liquidity sweep in a downtrend and how you can trade it effectively. Let's break it down step by step. Let's start by identifying the key liquidity zones. In this downtrend, the price has been steadily moving lower, creating sell-side liquidity below previous lows. These areas are where retail traders have placed their stop losses for long positions, hoping the market will hold those levels. But smart money has other plans. Now, as the market approaches one of these key lows, it suddenly makes a move down, breaking through the previous low. This is where retail traders get stopped out as their stop-loss orders are triggered, thinking the market is going to reverse. However, this move is actually a liquidity sweep, a tactic used by market makers to grab liquidity and reverse the price. After the sweep, smart money will have collected the liquidity they were after, and they're ready to reverse the price direction. Now, on the chart, we see that the market closed above the previous low, confirming the liquidity sweep. This candle that closed above the previous low is our signal that the reversal is about to begin. Once we've confirmed the reversal with the candle closing above the previous low, we're ready to place our trade. In this example, the sell-side liquidity was taken, and now we're looking to enter a long position as the price starts reversing upward. Your entry should be placed right after the candle closes above the previous low to catch the reversal early. For risk management, we place our stop loss just below the liquidity zone, in this case just below the previous low that was swept. This keeps our risk tight while giving the trade enough room to breathe as the price reverses upward. For take profit, we aim for the next key resistance level, ensuring a 2-to-1 risk to reward ratio to maximize our gains while keeping risk under control. The same approach applies in an uptrend, but in reverse. You'll be looking for a liquidity sweep above a previous high and then enter a short position after confirmation. Now that you understand what liquidity is and how it works, let me share with you 3 powerful liquidity patterns used by market makers. These patterns will help you spot where smart money is operating and how you can take advantage of these opportunities in your trading. Let's start with one of the most common liquidity patterns, equal highs and equal lows. Equal highs occur when the price reaches the same peak twice without breaking through, forming what retail traders see as a strong resistance level. This creates a horizontal line that traders interpret as a clear signal to place sell orders just below these highs, with stop losses placed right above, expecting the price to fall after retesting this resistance. Now let's take a moment to dive into the psychology behind equal highs. Why do these levels get so much attention, and how do market makers use them to their advantage? Let's break it down. Market makers and institutions know that retail traders place stop losses just above equal highs, viewing them as strong resistance levels. Smart money sees these levels as pools of liquidity and pushes the price slightly above them to trigger those stops, capturing the liquidity before reversing the market. By driving the price above these equal highs, market makers trigger stop losses, causing a liquidity sweep. After gathering this liquidity, they reverse the price, leaving retail traders trapped in losing trades and profiting from the false breakout. Now that we understand the psychology behind equal highs, let's move on to something even more practical: how to spot and trade equal highs liquidity patterns. This is where the real opportunity lies, so let's break it down step by step. Look for horizontal resistance where the price has tested the same high level twice or more without breaking through. This signals that many traders are seeing this as a strong resistance zone. When the price starts to break above these equal highs, don't rush in. Wait for confirmation of a false breakout. If the price moves above the highs, closes above it, but then suddenly reverses and closes back below the equal highs, you can anticipate a liquidity sweep. As you can see here, this is a clear buy-side liquidity sweep. Sellers who placed their stop losses above the highs got triggered, and beginner traders, thinking it was a breakout, jumped in only to be caught off guard when the market closed below the equal highs, hitting their stop losses as well. This is a common market maker trap that happens frequently in the market. Once the price reverses and closes below the equal highs, you can enter a short trade after the false breakout. Place your entry at the candle that closed below the equal highs, with your stop loss just above the liquidity zone. Your target should be the next logical support level, aiming for at least a 2-to-1 reward to risk ratio. Equal lows form when the price reaches the same low twice, creating a perceived support level. Retail traders often view this as a safe area to place buy orders, expecting the price to hold at support and bounce back up. They typically place stop losses just below the lows, anticipating that the support will protect their trade. Smart money recognizes that retail traders place stop losses just below equal lows, expecting the support to hold. Market makers use this as an opportunity to trigger those stop losses by briefly pushing the price below the lows, creating a fake breakdown before reversing the market upward. Now let's dive into how you can spot and trade these equal low liquidity patterns. Look for horizontal support where the price has tested the same low level twice or more, forming a zone where retail traders are likely to place their buy orders. Watch for the break and reversal. As the price drops below the equal lows, don't immediately go short. Watch for a liquidity sweep, where the price briefly breaks the lows but fails to close below them. When the price reverses and closes above the equal lows, it indicates that smart money is sweeping liquidity and preparing for a reversal. Once the price reverses, you can enter a long trade after the false breakdown, placing your stop loss just below the liquidity zone. Your target should be the next logical resistance level. Now that we're diving into the next level of market maker strategies, let's explore something that goes unnoticed by most retail traders. What if I told you that smart money, those institutional traders and market makers, have a calculated process to trap traders over and over again? This hidden strategy unfolds in 3 critical market phases: accumulation, manipulation, and distribution. Let me walk you through each phase step by step, so you can understand how they work, and more importantly, how to use this knowledge to stay ahead and avoid their traps. The accumulation phase is where smart money quietly prepares to make its move. On the chart, this phase looks like a period of consolidation or sideways movement. The market seems calm, stuck in a defined range, and it might seem like nothing significant is happening. But beneath the surface, smart money is already building its positions, accumulating long or short positions depending on their game plan. They do this subtly without causing major price shifts. Retail traders often look at this phase and see it as a time of indecision or low volatility. But for smart money, it's like laying down the foundation before the big move. Then comes the manipulation phase, and this is where things start to get interesting. Smart money has already positioned itself during the accumulation phase, and now it's time for them to trigger a liquidity sweep. They deliberately push the price below support or above resistance, creating what looks like a breakout or breakdown to retail traders. At this point, retail traders either panic and close their positions, or they rush in, thinking they're catching the next big move. But guess what? It's all part of the trap. Smart money grabs the liquidity by triggering stop losses. And just when retail traders think they're riding the breakout, the price snaps back in the opposite direction. And now we arrive at the distribution phase, the final act in this carefully orchestrated strategy. After the price has surged up or down following the manipulation phase, smart money starts to offload its positions. But here's the trick. While they're taking their profits, they're setting up another liquidity trap, this time at the resistance level in a bullish scenario. Retail traders are lured into thinking the price will continue rising, so they start buying at the top. It looks like the perfect opportunity to hop on a strong upward trend, but in reality, smart money is quietly selling their positions to these traders. As soon as the retail traders pile in, the price reverses sharply, trapping them in a losing position while smart money walks away with the profits. Now that we've laid the foundation by understanding the 3 key market phases, accumulation, manipulation, and distribution, let's dive into how you can spot liquidity sweeps in real chart examples. This is where smart money leaves its footprints, and learning to recognize these will give you a serious edge in the market. Take a look at this first chart. The market was in a distribution phase. Then it broke down and moved lower. After that, the market started trading horizontally within a range. This is what we call the accumulation phase. It looks calm on the surface, right? Retail traders are busy buying and selling at the boundaries, placing their stop losses just below support and above resistance, hoping the range will hold. But here's where it gets interesting. As you can see, the market suddenly breaks below the range, triggering the stop losses of those buyers. But then watch what happens. The price reverses and closes back inside the range. This is what we call a sell-side liquidity sweep. Smart money just pulled a classic trick. By pushing the price down, they triggered the stop losses of retail traders who had entered long positions, making them think a breakout to the downside was happening. At the same time, breakout traders jumped in, thinking they had caught the start of a new downtrend. But just as quickly, the market reversed, trapping buyers, breakout traders, and beginner traders alike in a false breakout. So what should you do when you spot a liquidity sweep like this? Simple. Wait for the market to close back inside the range. Your entry should be placed at the close of the candle that returns inside the range, with your stop loss just below the support level and your target set at the next resistance level. But look at what happened next. The market hit your stop loss and then reversed again to close inside the range. I wanted to show you this example to highlight two things. First, this strategy isn't a holy grail, and you will lose some trades. Second, I wanted to show you what to do when this happens. Even banks and institutions can trap each other in the market. In this situation, market makers are testing your nerves, but you need to stay calm, accept the loss, and be ready to re-enter once the market closes back inside the range again. Place your stop loss below the support level and target the next distribution phase. Why target the distribution phase? After this trap, the market is likely to move up strongly, and the most powerful level it will encounter is the support level of the distribution phase, which has now become resistance. As you can see, this trade offers a 2.8 to 1 reward to risk ratio. If you consistently take trades with at least a 2 to 1 reward to risk ratio, you'll always come out ahead in the long run. Even if the strategy only works 55% of the time, you'll still end up a winner because the risk management is solid. Look at what happened. The market moved up, broke through the range, and hit our target as expected. Now let's shift focus to the distribution phase and see how smart money uses liquidity sweeps to trap retail traders at resistance. Take a look at this chart. The market was in an accumulation phase, where buyers and sellers were trading within a range. Then market makers created a sell-side liquidity sweep before driving the price upward. After the accumulation phase, the market started trending higher. But soon, it moved sideways into a range again. This is where things get tricky. You might wonder, is the market going to break through and keep climbing, or will it reverse? Here's the answer. The market breaks above resistance, making it look like the uptrend will continue, but then it reverses back into the range. This is a classic sign of the distribution phase. What happened here? Smart money took advantage by triggering the stop losses of sellers above resistance. At the same time, breakout traders thought they had caught the beginning of a new upward move. They entered long positions, only to be trapped when the market quickly reversed, creating a false breakout and another liquidity sweep at the resistance level. So how do you trade this setup? Once again, you'll be looking for a close back inside the range. In this case, we have a candlestick that closes inside the range, indicating a strong reversal. Place your entry at the close of this candle, with your stop loss just above the liquidity sweep zone, and target the next accumulation phase. Why target the next accumulation phase? Because after the buy-side liquidity sweep that occurred during the distribution phase, it's a signal that the market is likely to break down from the range and move lower. The most significant level the market will face is the accumulation phase, meaning the previous resistance now acts as support. Now, let's move on to one of the most practical liquidity patterns you should consistently watch for, the trendline liquidity pattern. Whether you're trading in a bullish or bearish market, understanding how liquidity builds up along trend lines is crucial for spotting smart money moves. Let's first look at the bullish scenario. Imagine a market structure like the one shown here. After a bullish break of structure to the upside, we notice the price leaves behind inefficiency. Following the creation of a new major high, the market retraces downward, then begins to form a series of small breaks of structure as it moves upward, but these moves are tiny and lack significant liquidity sweeps. The key here is the repetitive formation of small breaks of structure. Essentially, the price is creeping upward, forming higher highs and higher lows that are all close together. This type of movement generates a trend line. Retail traders who rely on trend lines and patterns often jump in with long positions every time the price touches the trend line, placing their stop losses just below it. As this behavior repeats, it creates a substantial pool of liquidity below the trend line, made up of retail traders' stop-loss orders, waiting to be grabbed by the market. The price is likely to push downwards at some point to clear out this liquidity, triggering those stop losses. By doing so, smart money aims to fill the inefficiency left behind and tap into the demand zone located at the extreme low of the structure. At this point, there's an opportunity to consider entering a long position from that demand zone after the liquidity below the trend line has been swept. The main objective of smart money is to enter the market only after retail liquidity has been cleared. So, as traders, our job is to wait for confirmation of the liquidity sweep before entering a trade. Now, let's shift our focus to the bearish scenario and see how this pattern plays out in a downtrend. The same concept applies, but in reverse. Here, the market forms a bearish break of structure, leaving behind an unmitigated supply zone in the wake of the break of structure. The price moves downward with inefficiency, and then, just like in the bullish scenario, it starts creating small breaks of structure to the downside, gradually building a trend line from these minor highs and lows. As the trend line forms, many retail traders are drawn in, taking short positions at each touch of the trend line, placing their stop losses just above it. Over time, this creates a pool of liquidity above the trend line, made up of those stop losses, waiting to be taken out by smart money. What typically happens next? The price is likely to push upward briefly, clearing out the liquidity above the trend line and triggering stop losses. This move fills the inefficiency left behind, and the price reaches the supply zone. Once the liquidity from retail traders has been cleared, we have a strong confluence, a signal to enter a short position from the supply zone. By waiting for the liquidity sweep and the price to tap into the supply zone, we align ourselves with smart money. After this sweep, the price is likely to reverse from the supply zone and continue downward in the dominant bearish direction. Now that we've covered the key liquidity patterns and how to trade them, you're well on your way to mastering these powerful strategies. It's all about aligning yourself with smart money and avoiding the traps that catch so many retail traders. Thanks for watching. I hope this video helped you understand how to spot and trade liquidity patterns like a pro. If you found value in this content, don't forget to give it a thumbs up and subscribe to the channel so you don't miss out on future strategies that can transform your trading. And if you have any questions or want to share your thoughts, drop a comment below. I'd love to hear from you. Keep learning, keep trading smart, and I'll see you in the next video.